Almost no one knows how to short sell correctly, not even most professionals. A friend of mine learned that the hard way. It was Tesla, late 2020. He thought it was too high. He shorted it. But the stock doubled, and then doubled again. His losses spiraled. Margin calls rang. He doubled down, convinced he was right. The market doesn't care what feels logical. It only cares about timing, structure, and supply versus demand. By the time he finally gave up, the loss was 6 figures. And yes, Tesla eventually cracked months later. But too late for him. This is the trap that kills short sellers, acting too soon or for the wrong reasons. Stick with me, because in this video I'll show you when shorting is even worth attempting. What structures reveal distribution and hidden selling pressure, and the psychology tools that keep you from blowing up. This isn't about prediction, it's about survival. My name is Ben, and welcome to Zen Stock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. The lessons from that Tesla story didn't just come from my own scars. They line up almost perfectly with a classic playbook I keep close at hand. It's called How to Make Money Selling Stocks Short by William J. O'Neill and Gil Morales. And here's the punchline they open with: hardly anyone, even pros, knows how to short correctly. What struck me most was their first rule: only short in a developing bear market, never in a bull. That single idea reframed how I look at timing, structure, and psychology. And that's the roadmap we'll follow in this session: context, timing, and psychology. I keep a folder on my desktop called Autopsies. Not charts, not P&L screenshots. Autopsies. Because when a trade goes wrong, or even when it goes right but felt fragile, I dissect it. Like a surgeon after a failed operation. What killed it? What saved it? What pattern should I recognize next time? The case on my desk today: shorting Peloton in 2022. Setup. Peloton was the poster child of lockdown euphoria, at-home fitness, celebrity endorsements. A ticker that symbolized a cultural moment. By early 2021, the stock screamed past $150. Most traders I've mentored over the years see a chart like that and immediately think, short it, it's gone too far. But here's the first rule from O'Neill and Morales: you don't short just because it feels high. That's how most traders blow up. But the book makes it clear you short only in a developing bear market, and you don't try to catch the exact top. A top is a process, often taking months to complete. So instead of rushing in, I waited. The first trap. By mid-2021, Peloton cracked its 50-day moving average. Some traders I know piled in there, but O'Neill warns, the optimal shorting point is often 5 to 7 months after the peak, often marked by the 50-day crossing below the 200-day, the so-called black cross. But impatience is powerful. One of my friends shorted too early. The stock ripped right back above the 50-day. He covered in panic. Weeks later, it rolled back down, proving his idea right, but his timing wrong. That's the psychology trap: being right in thesis but wrong in sequence. Overhead supply. Fast forward to late 2021. Peloton was in decline. But then came the counter-trend rally. The tape clawed higher on weak volume, pushing straight into a zone where thousands of traders were still trapped from buying near the highs. This is what the book calls overhead supply. Those traders weren't investors anymore. They were desperate to get out even, and every uptick gave them an excuse to sell. I see this mistake with retail traders all the time. They ignore supply zones and assume a bounce means strength. In reality, it's just trapped sellers unloading. Distribution. But here's what really gave me confidence. The broader market was weakening. The indexes were logging multiple distribution days, heavy volume declines that signal institutions are selling into rallies. The book's guidance is simple. When you see 3 to 5 distribution days within 2 to 4 weeks, you raise cash and re-evaluate longs. And if you're hunting shorts, that's your window. So the wind was finally at my back. The entry. I built the short, as Peloton stalled right at the 50-day moving average from below. That's critical. O'Neill and Morales note that after the first decisive break under the 50-day, a stock often rallies back above it 2 to 4 times before failing again. Those repeated failures often form the right shoulder of a head and shoulders top. That's where I entered. Risk first. My position size was capped. My cover stop sat just above the swing high. My profit target? A modest 20 to 30% move, exactly the range the book suggests for shorts. The test. Then came the gut punch. A rumor of a buyout hit the tape. Peloton gapped up overnight. My P&L bled red. Most traders I know panic here. They think, I was wrong. Get out before it's worse. I almost did. But the tape told me something different. The rally was wedging, climbing on lighter and lighter volume. That's not strength. That's exhaustion. So I held. In fact, I added one last piece with the clear rule: if this wedge turned into a breakout, I'd cover instantly. The collapse. The next session opened weak, then cracked. Peloton flushed through support. I scaled out in stages, partial covers at 20%, then 30%. Not perfect, but safe. Survivable, repeatable. The autopsy verdict. When I wrote the autopsy, the win wasn't about predicting Peloton's fate. It was about sequence. The general market was weakening, distribution. The stock had topped months ago, timing. The moving averages confirmed, black cross. The rally failed at supply, structure. The exit plan was predefined, risk. And, most importantly, I wasn't reacting to my emotions. I was following a system. That's the psychology edge O'Neill and Morales hint at, but don't say outright. Successful shorting isn't about bravado. It's about discipline. What you just heard wasn't luck. It was a process. And that's really what this video is about: how to short sell without turning it into financial self-destruction. Here's the framework I live by. 3 pillars. First, context. The general market must already be weakening. O'Neill and Morales are blunt. Shorting in a bull market almost never works. Second, timing. Tops take months. The best shorting windows often appear 5 to 7 months after the peak, often near that black cross when the 50-day drops under the 200-day. Third, structure. Look for patterns like head and shoulders tops, late-stage failed bases, and rallies into overhead supply. But let me be crystal clear, short selling is never safe. Even in the right environment, with the right structure and the right timing, risk is always present. The goal isn't perfection, it's survival. So as we go deeper, keep this disclaimer in mind: this is education, not financial advice. And no setup removes the risk entirely. What we're building is a framework that stacks probabilities in your favor, while protecting your psychology from the traps that destroy most traders. For me, short selling is like surfing a rip current. You don't beat the ocean with strength, you align with its pull. The biggest trap I see in traders I mentor is trying to fight the tide, shorting too early or in the wrong market phase. They think they're being contrarian, but really, they're just swimming against a current that will drag them under. O'Neill and Morales make the same point in market terms: short only when the larger tide is already turning. That's when probabilities stack in your favor. So the mindset shift is simple: stop trying to outsmart the wave, wait for the current, then ride it. That's the essence of disciplined short selling. The first and most important filter in short selling is the market itself. William O'Neill and Gil Morales call this Cardinal Rule 1: sell short only during what you believe is a developing bear market, never in a bull. Sounds simple, but in practice this is where most traders fail. I remember mentoring a trader, let's call him Chris. He was obsessed with shorting Apple during its monster bull run in the 2010s. His logic was always the same: it's too high, it has to come down. And every time he shorted, the stock ground higher. Slowly at first, then fast. But here's the psychology trap: overconfidence and illusion of control. Chris believed he saw something the market didn't. He thought he could outsmart trillions of dollars of institutional demand. What he really did was place himself directly in front of a freight train. The lesson is brutal but clear. In a bull market, even the ugliest chart can squeeze higher. Liquidity, optimism, and institutional buying override your logic. That's why O'Neill emphasizes watching the indexes. S&P, Nasdaq, Dow, not just individual stocks. Because the tide moves all boats. 3 to 5 distribution days in a few weeks. Institutions are selling. That's your signal the tide may be turning. But if the indexes are still climbing on strong volume, stay away from shorts. Behavioral finance backs this up. A 2008 study on overconfidence in trading found that traders who believed they had special insight traded 35% more frequently and underperformed by almost 6% annually compared to peers Barber and Odeon, 2018. Overconfidence isn't an edge, it's a tax. So here's the rule I now live by. I don't short just because a stock looks extended. I first ask, is the market itself weakening? If not, I stay out. The market context rule is your first shield against disaster. Ignore it, and you're not shorting, you're gambling. The second pillar is timing. Here's the truth that most short sellers don't want to hear. Tops are not events, they're processes. O'Neill and Morales hammer this point. The optimal shorting point usually shows up 5 to 7 months after the absolute peak, often when the 50-day moving average sinks below the 200-day, the so-called black cross. But impatience ruins traders long before that moment arrives. I've seen it countless times in my mentoring. One trader, Sarah, called the top on Shopify in early 2021. She shorted it within days of its all-time high. And she was right about the story. E-commerce growth was slowing, demand was fading. But she was wrong about timing. Shopify didn't crack immediately. It rallied for weeks, punishing her position. By the time the real breakdown came months later, she was already out, nursing a massive loss. This is the psychological trap of impatience and overtrading. We want to be early because early feels smart. But in short selling, early is just another word for wrong. The book makes a critical analogy. Just like you don't buy a stock at its absolute bottom, you don't short at its absolute top. You let the base form. You let the cracks spread. You wait for the market to confirm. Behavioral finance research supports this too. A 2019 study on trading impatience found that traders who entered positions too early before confirmation underperformed disciplined peers by 4.7% annually. The cause wasn't poor ideas, it was poor sequencing. My personal rule now is simple. If a stock has just peaked, I set a cooling off timer. No shorts until at least 3 months have passed, ideally longer. That forces me to wait for the market to show its hand, overhead supply, distribution, failed rallies. The difference is night and day. I no longer feel like I'm calling tops. I feel like I'm stepping in only once the narrative is exhausted and the weight of supply is visible. That shift from ego-driven timing to system-driven timing has saved me from more premature shorts than I can count. The third pillar is structure. Markets leave fingerprints when a stock is topping. You just need to know what to look for. O'Neill and Morales highlight a few patterns that show up again and again: head and shoulders tops, late stage, wide and loose bases, failed breakouts on weak volume. I'll give you a real example. Netflix in 2022. Setup, after years of dominance, it hit new highs, then suddenly stalled. Traders kept buying the dips, anchored to the story of endless streaming growth. But the chart was telling a different story. Netflix built a head and shoulders, left shoulder in late 2021, the head at the peak, then a weak right shoulder that rolled over at the 50-day. Volume swelled on down days, shrank on up days. Textbook distribution. Here's the psychology angle: confirmation bias. Investors saw what they wanted to see: a bargain, a temporary pullback. They ignored the structural evidence that institutions were unloading. I saw this exact bias in a trader I coached. He kept averaging down on Netflix, convinced the bounce would come. He was looking at the company narrative, not the chart structure. By the time he gave up, the stock had already lost half its value. The book warns us about overhead supply for exactly this reason. Every failed breakout adds more trapped buyers above current price, waiting for a chance to sell. That hidden supply acts like gravity. Behavioral finance research has a name for this: anchoring. A 2010 study found that investors anchor to past high prices and hold losers 21% longer than winners. They aren't trading the present, they're trading their memory of what the stock should be worth. That's why structures matter. They cut through narrative and memory. They show the actual battle between supply and demand. So my rule is this: I don't short because of valuation or because of a hunch. I short when I see a structural failure, a head and shoulders top, a failed rally, or a stock slamming into overhead supply on weak demand. The market tells the story in price. My job is to listen. The fourth pillar is risk. Short selling feels thrilling, fast moves, big drops. But if you don't define risk first, it will define you. O'Neill and Morales are blunt. Set 20 to 30% profit objectives and take profits often. Shorts collapse quickly, but bounces are brutal. I'll never forget a trader I knew, Mark. He shorted AMC during the 2021 meme mania. His thesis was sound, the fundamentals were terrible, the rally unsustainable. He had profits, big ones, as the stock dropped 25% in a week. But he didn't cover. He wanted more. And that's when risk psychology flipped. A flood of retail buyers squeezed the stock higher. In 2 days, he went from green to deep red. Instead of stopping out, he held loss aversion in full swing. He couldn't stand locking in a loss after sitting on such big gains. By the time he capitulated, the account damage was catastrophic. This is the trap. We rationalize holding losers longer than winners. Behavioral finance research backs this up. The classic Kahneman and Tversky 1979 study showed that people feel losses about twice as strongly as gains. In trading, that bias makes us cling to losers and cut winners too soon. That's why I now predefine every short in writing: entry zone, cover stop, profit target 20 to 30%. And I honor those levels no matter what story my brain spins in the moment. The truth is, risk management isn't about being smart. It's about building rules that protect you from your own psychology. Here's the reframe that helped me. Think of short selling as survival, not conquest. Every dollar of risk you don't lose keeps you in the game long enough to catch the next high probability setup. Because short squeezes will happen. Rumors will gap stocks against you. Headlines will punish your timing. You can't avoid it, but you can survive it. Risk first, always. The fifth pillar is persistence. Even with context, timing, structure, and risk nailed down, short selling will still stop you out more than you'd like. That's just the nature of the game. O'Neill and Morales stress it clearly. Successful short selling requires discipline and persistence. You'll be wrong often. You'll cover early. You'll get squeezed out. The key is how you respond. I remember one stretch in 2018 where I tried shorting Facebook 3 times. The first 2 attempts failed, stopped out almost immediately. Each time, I felt the sting. The temptation was to revenge trade, to prove I was right. But revenge is poison. Ego tells you that one losing trade is an attack on your identity, and that trap is what blows up accounts. Behavioral research calls this the ego depletion effect. When we tie our self-worth to outcomes, we burn emotional energy and make worse decisions. A 2012 study found that traders who internalized losses as personal failures increased their risk-taking by 32% in subsequent trades. The antidote is reframing. I now treat each stopped-out short not as a failure, but as a data point, a probe, a test. The book reminds us the point isn't to nail the exact top. It's to identify the moment when the weight of supply finally overwhelms demand. Sometimes that takes multiple attempts. So persistence isn't stubbornness, it's patience plus discipline. You wait for the right window, you test, you cut quickly when wrong, and you stay emotionally steady until the market finally confirms. My Facebook example. The third short was the one that worked. The stock cracked after 2 failed rallies, and because I'd stayed small and disciplined on the first 2, I had capital and clarity left to size up on the third. That's the essence of persistence in short selling, not giving up, but also not letting ego drive you into revenge trades. Every stop out is tuition. Every entry is a test. And the payoff comes only to the trader who survives long enough to see the tide truly turn. The 5 pillars we just covered, context, timing, structure, risk, persistence, aren't just ideas from one book. They're backed by both history and behavioral science. Evidence for context. Bear markets are where shorts thrive. History proves it. In 2008, the S&P 500 dropped more than 50% in just 17 months. During that period, disciplined short sellers captured moves of 30 to 70% in former leaders like Lehman Brothers and Citigroup. But here's the catch. Traders who tried shorting before the market rolled over in 2007 were often forced out early. Timing the general market was the difference between ruin and reward. Behavioral finance echoes this. Barber and Odeon's landmark 2001 study found that overconfident traders underperformed the market by 6.5% annually. Shorting a strong bull market isn't contrarian. It's overconfidence. Evidence for timing. O'Neill's rule about waiting months after the peak isn't theory, it's pattern recognition. Take the dot-com crash. Many leaders peaked in March 2000, but the most profitable short entries didn't show up until late summer, 5 to 7 months later. Cisco, Sun Microsystems, and JDS Uniphase all rallied multiple times before finally breaking down. Early shorts got squeezed. Patient shorts got paid. Academic backing? A 2019 study on trading impatience showed that traders who entered too early underperformed by 4.7% annually compared to peers who waited for confirmation. Evidence for structure. The head and shoulders pattern isn't just folklore. A 2005 study from Lowe, Mamaysky, and Wang analyzed thousands of charts and found that common technical patterns, including head and shoulders tops, had statistically significant predictive power, not perfect, but meaningful. Real world? Netflix in 2022. A head and shoulders top failed rally at the 50-day and massive breakdown. Traders who recognized the structure had a roadmap. Those who ignored it got blindsided. Evidence for risk. Short squeezes are brutal because of forced buying. The GameStop saga in January 2021 is a masterclass. Hedge funds with oversized short positions, no risk cap, no exit plan, were forced to cover as retail traders piled in. Losses ran into the billions. Behavioral finance explains this with loss aversion. Kahneman and Tversky's prospect theory showed that people feel losses about twice as strongly as equivalent gains. On the short side, that bias makes traders hold losers far too long, hoping for a reversal. Risk rules, like taking profits in 20 to 30% chunks, are the antidote. Evidence for persistence. Markets rarely reward the first short attempt. O'Neill reminds us, successful shorting requires discipline and persistence. History backs this up. Amazon took 4 failed rallies before finally collapsing in 2000. Traders who gave up after the first stop-out missed the real move. Psychology research agrees. A 2012 study on ego depletion found that traders who personalized losses as failures increased their risk-taking by 32%. The ones who reframed losses as tests maintained consistency. The takeaway. The data, the history, the psychology, they all point to the same truth. Short selling isn't about hero calls. It's about process. And process means respecting context, waiting for timing, recognizing structure, managing risk, and persisting with discipline. That's how you turn short selling from self-destruction into a repeatable strategy. Even with a framework, most traders still fall into the same psychological traps when shorting. I've seen these patterns over and over, in my own trades, in mentoring sessions, and in the average retail trader. Trap 1. Shorting too early. This is impatience dressed up as insight. A stock hits new highs, feels too expensive, and traders jump in. But as O'Neill points out, the optimal shorting point usually comes months later, not at the absolute top. I saw this in a trader who shorted Tesla in late 2020. He was early. The stock doubled again before rolling over. His thesis was right, but his timing was fatal. That's not insight, it's ego. Trap 2. Overconfidence and fighting the market. Traders think they can outsmart the crowd. They short in strong bull phases, convinced they've spotted the top before anyone else. But markets aren't puzzles to solve, they're tides to ride. Behavioral finance research shows overconfident traders underperform by more than 6% annually. The more they trade, the worse it gets. In practice, this trap looks like standing in front of a freight train and hoping it stops. Trap 3. Revenge trading after a squeeze. This is one of the deadliest. A trader shorts, gets squeezed, takes a loss, and then jumps back in, bigger, fueled by anger. I've done this myself. It never ends well. Psychology research calls this loss chasing. After a loss, the brain seeks to restore balance, but it usually does so recklessly. A 2012 study found traders increased risk by 32% after taking losses they tied to their identity. That's not persistence, that's revenge. The pattern is clear: impatience, overconfidence, and revenge don't just drain accounts, they destroy the trader's psychology. The only way around them is rules and reframing, patience instead of early calls, respect for market context instead of ego, and discipline instead of revenge. That's how you avoid becoming another short-selling casualty. Complex systems collapse under pressure. So when it comes to short selling, I keep my rules brutally simple. Here are the 2 toolkits I actually use. Toolkit 1, the 3 yes rule. Before I short, I ask 3 questions. Is the market weak? At least a few distribution days on the indexes. Is the stock late? 3 to 6 months past the peak, ideally after a black cross. Is the pattern clear? Head and shoulders, failed rally, or overhead supply. If I can't say yes to all 3, I don't short. Simple as that. Toolkit 2, the 20 to 30 rule. Once I'm in, I stick to 2 numbers, 20 to 30% profit target. Take covers in chunks as the stop falls. Stop above the recent swing high, no moving it, no excuses. And for my psychology, I add 1 safety net, 1 and done. If I get squeezed out, I don't touch the same stock again until the next day. No revenge trades. That's it. 2 toolkits. The 3 yes rule for entries. The 20 to 30 rule for exits. Everything else is noise. Now let's turn the focus on you. Think about your last few trades. Did you short a stock just because it felt too high? Or did you wait for the market itself to weaken first? When you look back, how much of your decision came from a clear checklist and how much came from emotion? Ask yourself this. Do I have a written rule for when I will not short? Do I know my exact stop and target before I hit the button? Am I patient enough to wait months after a peak? Or do I jump in too soon because I want to be the one who called the top? Here's the deeper question, and it's one I've had to face myself. When I take a loss on a short, do I treat it as a test and move on? Or do I let my ego turn it into a grudge match against the stock? The honest answers to these questions will tell you more about your readiness to short than any chart pattern ever could. Because short selling isn't just about setups, it's about your psychology. And if you don't know yourself, the market will teach you the hard way. You've now seen the framework, context, timing, structure, risk, persistence. But here's the truth. Knowing it and living it are 2 different things. So here's my challenge to you. Before you click away, take a moment and write in the comments the biggest insight you pulled from this video. Not just what you heard, but what you're going to apply. And if you know a trader who keeps getting crushed by short squeezes, share this video with them. You might save them months or even years of pain. And of course, if you found value here, hit like, subscribe, and turn on notifications. That's how we keep building this community of traders who want clarity, not chaos. Because at the end of the day, trading isn't about being right. It's about surviving long enough to thrive, master your mind, master the market, trade with confidence, and live with calm.